Hey everyone, and welcome back to The Explainer. Today we're putting Amalgamated Financial, trading under the ticker symbol AMAL, right under the microscope. We're going to analyze their first quarter 2026 earnings through the rigorous lenses of legendary value and growth investors to see if this totally unique niche bank actually belongs in a well-constructed portfolio. We've got this really compelling mix of missed expectations on one hand and explosive foundational growth on the other. It's a true financial puzzle, so let's dive into the data. So here's our roadmap for today's explainer. First, we'll get to know Amalgamated Financial. Second, we'll break down that Q1 financial performance. Third, we'll track market sentiment by looking at dividends and market activity. And finally, we'll wrap up by looking ahead to Q2. All right, let's jump right into part one. Meet Amalgamated Financial, a bank with a mission.
Now, Amalgamated Financial definitely isn't your standard run-of-the-mill regional bank. They were founded over a century ago, back in 1923, by the Amalgamated Clothing Workers of America. Today, they operate as a fully insured commercial bank, but with a very tightly focused mission, serving labor unions, progressive nonprofits, and mission-driven organizations. They're actually a certified B Corporation, which means they are legally committed to balancing profit with purpose. Basically, organizations that want their capital perfectly aligned with their social values park their money right here. In Warren Buffett's terms, this is what you'd call a classic economic moat. It creates a highly loyal, highly specific customer demographic that really protects the bank from typical retail deposit flight.
Moving right along to Section 2, Q1 Financial Performance, the miss versus the growth.
Let's just address the immediate headline for Q1, which, let's be honest, was a bottom-line miss. Wall Street consensus expected earnings per share to come in at 95 cents, but the actual reported EPS was 80 cents. Now, that's a 15-cent miss, which usually triggers some pretty loud alarm bells in the banking sector. However, despite missing on profit, their revenue actually beat expectations, coming in at $91.36 million against an expected $91.16 million. So they're clearly bringing the money in the door, but their bottom-line efficiency took a slight hit. But look, any seasoned analyst will tell you that a single EPS miss is just noise if the underlying foundation is expanding. So let's look at that foundation. Check out this number right here, $229 million. That is their quarterly deposit growth. In a macro environment where a lot of institutions are fighting tooth and nail against deposit plight, adding nearly $250 million in cheap capital in a single quarter is absolutely phenomenal. This is the raw fuel a bank needs to generate income and fund commercial loans. This kind of top-line balance sheet expansion heavily counters the negative narrative of that earnings miss we just talked about.
Management actually refers to the core of this growth as super core deposits. They define this as commercial and consumer relationships lasting over 5 years. Remember that economic moat we talked about earlier? Well, it translates directly into this extreme customer loyalty. These highly stable, sticky deposits are now approaching a massive 60% of their total base. And even better, their average non-interest-bearing deposits increased to 41% of total deposits. That means a massive chunk of their funding costs them absolutely zero in interest expense. Literally nothing. This is a dream scenario for managing cost of capital.
And because they have so much of that zero-cost capital, their net interest margin, or NIM, actually rose to a very healthy 3.75%. Net interest margin is just the difference between what a bank earns on its loans and what it pays to its depositors. Despite broader economic pressures out there, Amalgamated expanded this margin. They successfully redeployed cash into higher-yielding securities and kept up strong commercial loan originations, which pushed their loan yields up 7 basis points to 5.18%. This proves they have real pricing power, which is a totally crucial metric for any fundamental investor analyzing a bank's long-term viability. Now, if we apply Benjamin Graham's defensive investor checklist, this clean balance sheet snapshot as of March 31st checks some really critical boxes. Total assets comfortably surpass $9.1 billion, backed by $8.17 billion in total deposits. And notice their leverage here. With $4.96 billion deployed into net loans receivable, loans make up only about 60% of their deposits. That means they have tremendous liquidity and they're definitely not over-leveraged. With stockholders' equity sitting incredibly strong at over $807 million and a Tier 1 leverage ratio of 9.33% that sits well above regulatory requirements, this is a rock-solid foundation perfectly capable of weathering economic shifts. Okay, on to Section 3, Dividends and Market Activity. Let's track the broader sentiment. Starting with shareholder rewards, Amalgamated Financial offers a very reliable dividend. They pay 68 cents annually per share, which translates to a roughly 1.41% yield paid out quarterly. But the really critical metric for value investors here is that 19.77% payout ratio.
Think about that. They're using less than a fifth of their earnings to cover the dividend. It offers a massive margin of safety, leaving them plenty of retained earnings to fuel further growth or execute share buybacks. Case in point, they aggressively repurchased 80,000 shares just this quarter. So who is actually holding this stock? A staggering 75.93% is owned by hedge funds and institutions. Now, interestingly, legendary investor Peter Lynch generally preferred low institutional ownership, basically believing it meant the stock still had room to be discovered by the broader retail market. However, with heavyweights like Invesco actively increasing their stake by 3.1%, empowered funds growing their position by 9.3% to over $4 million, and Janus Henderson Group opening a brand new position entirely, it's pretty clear the smart money believes the long-term value here far outweighs the fact that the secret is already out. But we also have to track the insiders, right? In early June, we did see CFO Jason Darby and Chief Accounting Officer Leslie Velaswamy sell a combined 5,500 shares in the $43 range. While Peter Lynch famously said insiders buy for only one reason but sell for many, context is completely key here. The CFO still directly owns over 79,000 shares, so this was just a standard portfolio rebalancing representing less than a 4% decrease in his total holdings. With total insider ownership still sitting at a very healthy 1.63%, there is absolutely no need to sound the alarm on executive sentiment.
And finally, Section 4, looking ahead to Q2, catalysts and expectations. The immediate catalyst on the horizon is the Q2 earnings report, dropping right before the market opens on Thursday, July 23rd. Wall Street has drawn a line in the sand at $92.1 million in expected revenue. With their recent portfolio repositioning, specifically selling off those lower-yielding securities largely in the rearview mirror now, management is perfectly poised to thoughtfully consolidate their core market share and deliver much cleaner earnings moving forward. Which really leaves us with the ultimate question as we approach July 23rd. Wall Street analysts expect a solid rebound, targeting an EPS of 99 cents for the second quarter. Amalgamated Financial clearly has a Buffett-style economic moat with its incredibly loyal, mission-driven customers. They have Benjamin Graham-level balance sheet safety, and they have the solid backing of institutional smart money. But can they convert these massive structural advantages into that bottom-line profit target this time around? Make sure you keep your eye on that upcoming earnings release. Thank you so much for joining me on this explainer, and as always, keep learning.